Hey everyone, Chris Lopez here, and in today's episode, we are going to do another deal analysis with Terrence Doyle and Ben Davis at the VareCo. And we're actually going through one of their first bigger deals they did here in Denver. It's actually a 23-unit apartment building that they purchased in the heart of the Highlands, like right around like 29th and Zuni, so right there in the heart of the Highlands. They bought that apartment building along with a duplex and also a lot of land. So they're going to take us through the whole process of how they took it down, and it's definitely an interesting story. Then how they started renovating it, which was another interesting story, and now that they're leasing it up. So lots of good information on here today. So Terrence, how are you?
Fantastic. I'm actually starting to break out in a sweat thinking about all of the interesting stories we have with this property, but other than that, very well.
All right.
Thanks for having me.
You'll make it through here?
I think we'll make it through,
All
yeah.
right. What about you, Ben? Do you need like a sweat rag or anything?
I'm hanging in there. I'm hanging in there.
All right. And a quick note as we go on here, as most of you listeners know, we are doing the real estate ride-along show through Bigger Pockets. And I think it was episode number 7, which we'll put a link to in the show notes. We actually walked this property. You guys want to see a video of the property itself, go check out that video. We have about a 20-minute walkthrough we did there to see it. This podcast will go into a much more deep dive into all the interesting stories, talk about the numbers, a couple pivots you guys did, just all sorts of stuff.
Yeah, and they can see the finished product.
Yeah. Well, that's a good point.
Yeah.
In the video, it's done. That was like a week before you guys started leasing it, right?
That's right. Yeah.
Yeah. All right. So I gave him the quick intro. Walk us through this whole deal, because this was almost 2 years ago you bought it.
2018, summer of 2018 is when we first walked this building. Then we closed December of 2018.
Wow.
And we just started leasing August of 2020.
So
which is a long time in between. Yeah, there's a lot that happened in the 18 months.
Well, that was
you actually
plan,
dropped
right?
me off the first day I was going. We were doing a ride-along show just ourselves.
Yeah.
Maybe with my sister or someone else that was in town. 2018, you guys actually dropped me off, and I was like, yeah, I'm going to go meet this seller. And that was the first time I met him, I think May of 2018. But, I think the first point for listeners to digest is that this property was listed. It was listed for $4.75 million in 2018. Actually, 3 different brokerages in Denver had it. And the seller had built the property with his dad in the 60s, so he was very emotionally attached to it. And the long and short of it is that he had over-leveraged, so he owned it free and clear. So they built it, he had no debt on it, was collecting cash flow, and then over time he made a couple bad decisions. He bought a property in the mountains. He went over budget on construction, so he took a loan out on this particular apartment building. It was a hard money loan because he didn't have financials. So he took out a hard money loan. It was at 9% with some points. And then over time, he did not improve the property. So every 5-10 years would go by, the roof would get worse, there'd be leaks. He wouldn't do any pest control, so there'd be roaches, bed bugs. He wouldn't repair the mold. I mean, it just got bad and worse and worse over time. So as you can imagine, the tenant class deteriorated as well.
So while the area around there is just skyrocketing,
that's right.
This is not skyrocketing.
This is the one eyesore on the street in the neighborhood, right? This is that one property that has police sirens every week, is having shootings, just has 5 or 6 or 7 people living in an apartment. It's that building in probably the best neighborhood to own in the city, as from a landlord perspective. So what had happened was he was upside down in the building. Tenants weren't paying because of the tenant class. So he was falling behind on this hard money loan. So there was a balloon payment coming up. And a lot of brokers knew that. So everyone was trying to throw him offers and do all this stuff. And he had been under contract several times in the 4s. And they weren't able to close. One of the times the financing fell through because the building was in such rough shape. Another time the buyer backed out due to the condition of the building. And so fast forward, the listing agreement from one of the brokers expires, and they weren't able to get a deal done after probably literally hundreds of showings. So then I had closed a couple deals with them the year before.
With the brokers?
With the same broker. So he calls me and says, hey, and I had toured it. And he says, hey, we lost the listing. This guy's really difficult to deal with. Why don't you just try and call him and see if you can get it done? He's really skeptical of brokers, but he needs a quick close. He's very motivated, and he needs a ton of construction. I think you're probably the only guy that could get it done in a reasonable budget and to where it makes sense to still buy this at a number that he would accept. So I think the first time I called him was in June of 2018, and I think he might have hung up on me. He said it was under contract. He was gonna close next week. I mean, just some delusional story that he had made up. So I called him the next week, and I just asked him, hey, did it close? And he was, no, and he might have hung up on me again. I think finally I meet him face-to-face in July. So fast forward, we're talking and meeting probably every 2 weeks. We're going back and forth. And then by September, he's like, all right, why don't you make me a real offer, and let's try and get this done. And I knew that he had a balloon payment coming up at the end of the year. And I think we started at like $3.5 million, and it was the apartment building with the duplex next door. The duplex next door was beautiful and had a big lot behind it. There was just a dirt lot that they were using for trash. They were, people staying there were hoarders. So it was misused.
That's right, yeah.
It was misused, but I knew that could be a parking lot, and there was some value there. And then there was a lot down the, on the lot next to that. So skip another duplex and then the lot. And he was using that as the parking lot. There was about 12 parking spots there. So we offered $3.5 million. And he basically said he was going to try and do something with someone else. He said that was too low. And I'll never forget it. We hadn't talked in probably 4 weeks. So this was in September. He calls me back in October and says, hey, would you do 3.8? And I was like, Mr. Franco, the best I can do really is 3.6. And then I think he might have hung up on me again. And then I get an email the end of October. So end of October 2018. So I'm like 5 months into this. And he sends me an email at like 7 a.m. and says, Terrence, drop the paperwork. I'm ready to accept an offer at 3.7. And I remember at the time I was like, I couldn't believe it. I think I jumped up and down. I might have punched the wall. My business partner was in the office with me at the time, and he thought it was like not real. So I called Mr. Franco. I said, Mr. Franco, he said, Terrence, just draw it up. Let's get this done. I need you to close in 30 days. And so it took like another probably 2 or 3 weeks to get the paperwork done, and we did end up closing he ended up coming back because he had some issue with the broker. He hadn't terminated properly, so he actually had to pay some commissions. So we actually had to inflate the price to 3.75. So we ended up closing 3.75 December of 2018. And we were able to, this was the first contract where we were able to get the seller to agree to let us take over management after we had executed the contract and we were hard on earnest money. So our earnest money was non-refundable. He agreed to let us manage the property. And the reason we did that was so we had 30-day head start to issue 30-day notices, help the tenants transition to other units into other buildings around the city, and so that way day one when we closed, we could start construction.
Okay. So
most of the time that's worked out really well. In this particular instance, it ended up not working out as well as we had hoped, but this was the first time we were able to execute that, and it ended up, on this project, we're probably paying $15,000 a month in holding costs. So it saved us $15,000 by being able to start managing the property on the day that we closed and have the building in a place that we could start working on it. So that was it. I mean, it was a crazy, experience. It really taught me, we were $1 million under what he had listed at, and no one thought that was possible. I mean, people around, other brokers were like, he'll never accept that. We brought him offers over $4 million. And so it's just a testament of, even if people say a number's impossible, if you're persistent and you have really good communication and the seller trusts that you can close on time. I think that was the key, is that he trusted that we were going to close. And I think with other people involved, with brokers and other sellers, he just didn't get that feeling that they were going to close when they said they were, because he had that large balloon payment.
Now, you closed before that balloon payment, right?
We closed before. Yeah, it was 30 days before.
So even though he was 6 months before that balloon payment, he was still being hard-headed to these offers above $4 million.
And you can imagine just someone that's gone through those highs and lows. I mean, he owned this thing free and clear. He built it with his dad. I mean, he had his initials like in the cement and the foundation. I mean, he walked me through every square inch of this building and all the things that him and his dad did when they built it. I mean, he was very emotionally tied to it, so it was a really hard thing for him to come around to, the mistakes he had made. I mean, he would call me sometimes at 11 o'clock at night and just be talking about how this was the best, building that him and his dad had ever built, and all the money he had made from it.
So they built multiple buildings?
He had 3 buildings in the Highlands that they had built, 3 of them, and he had to sell all of them. So, he was very emotional to it, and so I think it took him a long time to come around to the fact that, hey, I made some mistakes, I'm going to have to sell this, and I need to do it in a timely manner, and I need to do it with someone I can trust. So even though the number wasn't what he had originally wanted, I think he came around to the fact that he could trust us, and that trust was built over numerous coffee dates, meeting at his house, meeting downtown. I mean, I met him basically anywhere he wanted to. And so I think through persistence and communication and then just doing what I said I would do, every time. At one point he asked me to do a rent study to show him the rents. It was just every single time we got together, he wanted something else and that we had to produce, and we were able to earn his trust, and we were able to close on time, and I still actually talk to him to this day. He's wanted to come back and see the property, and so that was a really big learning lesson for me. At the time, it was the largest building I'd closed in Denver. It was the first time I had gone directly to a seller, the first time that I'd dealt with all those headaches, and it was the first time I had brought on a partner, an institutional partner, to finance and partner, JV on a project with me. So it was a lot of first, and I was really excited, and I learned a ton from that experience going through that.
So I got a couple of questions here, actually. So it's always interesting to me when you hear these stories, these sad stories, someone like this gentleman where, he built it with his father.
Right.
And then own it free and clear, then loses it. Like,
right.
For you as an investor, like, what lessons did you learn from him? Like, oh my gosh, I'm never going to do this because I don't want to lose, or I'm going to teach my kids so they don't screw it up one day type thing.
Yeah, I mean, everyone talks about it. He was over-levered. He owned it free and clear, and then he took out a loan against it because he was over budget on a project in the mountains that he really knew nothing about. It was like a rehab center 5 hours away. And obviously his skill set was him and his dad identified a great piece of land, and they did the construction themselves. And in the mountains, he didn't, build it himself. He hired other people, trusted other people, and it was outside of his wheelhouse. It was like a rehab facility or something.
Like a drug and alcohol rehab?
Something like that. Yeah, so there's a lot of state involvement, a lot of regulation, and he ultimately trusted the wrong people. And I think he ended up losing something like $5 or $6 million. I don't know the number, but it was a lot of money, north of $5 million. And so, the learning lesson is, number one, don't over-lever. He could have easily just cut his losses and not tried to take out the $3 or $4 million he had in this property. I think the loan he had on it was 3.3. So he could have easily just cut his losses and said, I'm not going to try and chase bad money with that project in the mountains. But he, really believed in it, and, I think he was conned as well by the wrong people. So, for me, the lesson really was you can't go into business with the wrong people. You got to stick to the things you know. He knew multifamily, he knew construction, he got away from that, and then he just over-levered. Okay. Had he never taken out a loan on that property, you can't really go wrong. You can't lose.
So, I mean, nothing dramatic here, just the common things like focus on your strengths.
Right.
Don't over-leverage. Just, the basics of the
fundamentals, yeah. Yeah,
okay.
Just stick to things that you have a competitive advantage at, and don't ever over-lever.
And so, kind of, I want to go into a little more details just about the contract process here with you. So, I know you wrote up your contract, and you guys did it directly, but then you talked about bringing an institutional partner on here. What was that relationship like, and those terms, the financing, all that stuff?
Yeah, so this was the first time that we'd ever done that. Prior to this, we had closed every project, just me and my two business partners, and we had done, between Des Moines and Denver, 300 units at the time probably together, so we had a really good track record. But we had kind of come to the realization that we could scale and do more and kind of scale our business model, which was buying these outdated buildings in Denver and Des Moines by using other people's money, charging them fees, and being able to put just a little bit of our money in and leverage other people's money to do the same thing, and ultimately get to the same place where we would control and own, hundreds of thousands of doors, but using less of our own capital. So I think the idea was right, but our execution on this one, we had just never done it before, so we didn't know what to expect. And I think some of the things that we learned was that we had to be much more clear on the business plan. I think going into it, you kind of assume that if you and I have a conversation over the phone, that like we have an understanding. But if what you put in writing isn't what you agreed to over the phone, if it's not in the English language on a piece of paper that you both sign, the conversation never existed. And amongst friends and peers, that works, or it's worked for me. But if you're doing it with people that you don't have a track record with, especially that invest for a living or fiduciaries for a living, that just is never going to work. So that, I think, was the first thing. I think the second thing was we had never had to be really detailed, like to every single dollar on the construction budget. Because once you go into business with someone else and you have a business plan of, hey, we're going to renovate this and we're going to lease it for this, every single thing needs to be documented. And, to that point, if we went $100,000 over budget, let's say on an apartment building, let's say there was asbestos or there was more mold or we had to do something else that the city required, it was our own capital and we knew that we were going to get out okay. So there was no harm done. And then when you start to take other people's capital, going $100,000 over budget's a much bigger deal. And obviously I understood that, but I didn't understand to what degree that would come into play. So that was a big learning lesson of just really understanding how to put the right budget in place, how to put the right language to protect me as the operator in place if I went over budget. And ultimately you just have to, there's just a different level of scrutiny that comes with when you take on other, when you're a fiduciary and people trust you with their capital, which I understood from a textbook standpoint. I hadn't lived it, I hadn't gone through it yet. So those are, the idea of, I think, raising money is attractive and being able to do deals with other people's money. But I think, it's so much the responsibility and the attention to detail and the scrutiny that comes along with that isn't really talked about that much. And so those were things that I, hadn't understood to that point that we ended up, learning some pretty tough lessons on.
And now during the due diligence inspection phase of this property, any major things pop out to you or any renegotiations during that period or?
So we were already at his bottom dollar.
Yeah.
We got to check the roof and the sewer, but I had been in every unit. Like I said, during those 5-6 months that I was meeting with the seller, he had showed me basically every part of that building. So I knew how bad I knew that there was roaches. I knew the plumbing was old. I knew the electrical was bad. I knew everything.
So did you just assume you were going to be replacing most
we
of it?
We just assumed we were going to replace. We assumed the worst in our budget, and the only thing that I couldn't see was the roof and the sewer. So we had 3 days to check the sewer, and then we went hard, non-refundable on $100,000. And the sewer, there actually were some issues, and he gave us a $10,000 price reduction. So he did, so he was pretty, when I showed him the sewer.
How major were the sewer issues?
They were pretty bad. We had to replace the whole line.
Okay, so more than $10,000 then.
It might have been 12 between the duplex and that, but he was pretty reasonable considering everything that he was going through. So he was pretty reasonable on that. He didn't give us $1 for the roof. But he did give us some money.
What was the issue of the roof? Just old and
leaking? It was just old. He hadn't touched it. Yeah, I was leaking in multiple spots. There was mold in multiple units.
Okay.
So yeah, it was bad. It was bad. I think I don't remember how early you saw it, but it was one of the worst buildings I had been in to that point.
Yeah, I saw it pretty early on before you owned it or under contract. I remember walking a couple of units, and it was definitely probably the worst building that I could imagine in the Highlands.
Especially for that area, yeah.
Yeah. All right, so, and then what's the exact game plan on here? So, you bought this, but you really wanted the apartment building, right? That was the main part of the portfolio. You wanted to do the apartment building.
Right.
Right next door is a duplex. Behind a duplex is that, I remember that now. You said a big dirt lot that was just full of junk. Yeah,
there was dirt bikes and motors. I think there was 100 and something bicycles and lawn chair. It was the wildest compilation of junk you'd ever seen. But it was they were, the people that were squatting there, they hadn't even paid him rent in 6 months, were adamant that we didn't touch it, their stuff. It was wild. They were so passionate about every single bicycle back there.
Did they clear it all out?
They did end up clearing it out, and whatever was left, we had to throw away. But they cleared out 90% of it.
Wow! So you didn't need 19 dumpsters for it?
Yeah, I think we did have a lot of dumpsters for the apartment building, but actually not for that back lot. So yeah, it was really interesting how people just. They knew where everything was at, and that was their they knew where they'd gotten the bicycle and what year. It was pretty interesting. But
and then next to that was the
parking lot.
There
was a parking lot,
and that was a standard kind of like that. I'll call it
it was a 4250 lot. It was a 4250 lot. Yeah, it was just narrow, and originally it was zoned for it was commercial mixed use up to 3 stories. But due to the setbacks and some of the new zoning, they were only able to build a house. So we actually flipped the lot. So we closed the lot and the duplex with private money, a guy that we'd worked with in the past. And then we closed on the apartment building simultaneously, all the same day, with a construction loan from a local bank in Denver. And that was the first time we had done a construction loan that large. And so that proved to be pretty difficult. But we closed with private money. We flipped the lot basically 7 days later.
So you already had the buyer lined up?
We already had the buyer lined up during due diligence.
And you sell it to a developer?
To a developer that ended up building I guess a 3,800 square foot townhome.
And do you know, was that his original plan?
He wanted to build a duplex. He ended up just building like a single family structure there.
Okay.
And they just finished. I think they're in their last week or two of finishing touches, and I'm interested to see that'll probably sell in the 1.5 range or something like that. So we flipped a lot for $425, and then
when you bought it,
we assigned like maybe 3.25 there, so we did pretty well on the lot.
So
we cleared a couple bucks on the close of that, and then we assigned $500,000 to the duplex, and that's done well. We've leased that up, and I think we're going to talk about the underwriting on that on a different show. But we renovated the top and the bottom of the duplex, 2-bedroom and a 1-bedroom, put washer and dryer, new kitchen, new bathroom, and leased that for a gross $4,200 a month. And then the apartment building we had the construction loan on, so that was kind of how we financed it. And basically, we were just able to save money by not having to bring as much cash to close on the lot and the duplex by doing it that way.
What were so for private money, was that your standard like 0% down?
Yeah, 0% down, 8%. Okay. Yeah, and we held that, and then we refinanced it once the construction was done, and it appraised for the exact amount we needed to take out the private money.
For the duplex?
For the duplex, yeah. And then we'd already sold off the lot and returned that capital.
What were the terms of the construction loan? Do you remember?
It was 70% of total cost. 70% of total cost. So I think we had the total cost at like 3.7. Ben will be able to give us the deal, but I think that the total cost was maybe 3.8 million, and they gave us 70% of that.
Right.
Yeah.
But it penciled out to be about 60% of the acquisition, and then 10% for renovation.
Okay.
So that's right.
And so, what was the renovation plan and budget for the apartment?
So the plan was to update everything. So we were going to, there was 5 or 6 rooms that had really bad mold to where the drywall was just falling down. And so you had to take down multiple sheets of drywall and get to the studs. And then some of those had mold on them, so we had to replace some of the studs. And so basically, because the project was so large, we hired a GC that I knew kind of well and had done some roof work for us in the past. And he basically had the bandwidth and said, hey, I can come in and help you. I can get you the permit. I can oversee this. And then we were just going to use one of our local crews to go in there and actually do the work, but he was going to pull the permit. And we had agreed to not do any work until he pulled the permit. And he had said that he was meeting with the city, and he had pulled the roof permit, and that the city wanted to see 1 or 2 other things regarding the interior, and then that would be approved. So he said, you know what, you can go in and start demo. There's not going to be any issues. And one of the mistakes I made was trusting his word instead of seeing an actual document from the city. But we had everything he had said to that point in other projects had worked out. I mean, he had pulled numerous roof permits first in the past and passed those, and we hadn't had any issues.
So this was your first not going to plan.
Yeah, so in January of 2019, we started demo, and we had taken a couple units down to the studs that had mold. We were just spraying those with kills, but we weren't changing the layout. We weren't adding any units. We weren't doing anything, in my opinion, that I, to that point, had thought we needed architectural plans or a building permit for. It was just going to be all like cosmetic changes, right? We were just going to do the windows. We were going to do new bathrooms, new shower fixtures, new flooring, new kitchen cabinets. And so basically, one of the units that you could see on the garden level, we had taken down all the way to the studs because it had really bad mold. It was one of those where the roof had leaked down, and he hadn't fixed it. And a city inspector that was seeing some of the work done down the street, because you have to remember, in this neighborhood, there's probably 3 or 4 large apartment buildings either in the process of getting built or that had just been finished. So the city, city inspectors were through there all the time. But I didn't think, we weren't trying to hide anything. I just didn't know. And he had told me he had been communicating with them and showed them what we were doing, and there was no issue. And so we got, basically, one of the city inspectors stopped by, saw that we had taken down the drywall in one of the units, and just assumed that we were like doing major construction, like doing framing and adding units or reconfiguring units, which is a big no-no on commercial properties. And so he gave us a stop work order. This was like February of 2019. And that GC for 4 months kept telling me like he was getting it solved, he was getting it in. Meanwhile, no work's being done.
So from February, March, April, May, we're just
waiting.
In a holding pattern.
We're just in a holding pattern.
Paying $15,000 a month.
That's right. 15. Yeah, that's what it was. Our holding costs were $15,000 a month, so it was really painful. And we knew that this, doing major renovations, obviously you could have to involve the city, but I just never seen anything. Normally, when we had a stop work order prior to this, we could get it resolved in 1 to 2 weeks. We could go down there, show them pictures, but because of this location, because of this particular city inspector, I mean, it ended up being much more intensive than I'd realized. And it turned out that this GC had lied to us, and he had never actually spoken with the city. They didn't know what we were doing.
Oh, he had, never talked to him once?
Well, he may have talked to him once, but they didn't have it documented. He had never even showed him the tenant finish that we thought the permit we thought we were pulling.
So when did you realize this whole process?
When we brought in another GC, and he basically called down to the city and said, "Hey, they have no
What month was this?
It was probably May.
Okay.
May of 2019. And so at this point, obviously, our investor is really frustrated. We're frustrated. The GC that we had hired is no longer responding. He'd actually turned off his phone, was no longer responding. He, I think, left the state. I still haven't heard from him.
So he just stopped responding to everyone, not just you.
To everybody, yeah. He just went AWOL. And so what ended up happening was we ended up having to hire an architect to draw plans for every unit as built, showing what the building was and what we were doing to it. We had to hire an MEP engineer, so a mechanical engineer, to show the mechanicals, so the HVAC, the boiler, the electrical, and the plumbing, and show that none of that was changing. They had to do calculations, verifying that the current electrical input from the city was enough to support those units, which turned out that it was not. I mean, we had to go. It ended up being a 5-month process just to get the plans drawn with the mechanical, and they had to do elevation. I mean, they had every single thing as if it was a new build. Basically, we had to start over and show drawings and plans and everything to the city, as if you would have to if you were going to build basically an apartment building.
And you started this around in May?
So we didn't end up starting it till July or August. And our investor, we wanted to meet with multiple architects and engineers and see who had experience in the area and who had done apartment buildings and so on and so forth. So that was a really long. And anyone that's done anything with the city knows, on a commercial level, once you get over 4 units in Denver, it can get really, really frustrating and very time intensive. I mean, it takes weeks and weeks and months, especially right now where there's a boom, and there's a lot of building going on, for them to review plans. And so, we submitted, they sent comments back, we submitted, take comments back. So we ended up getting the building permit approved in December. It was maybe a week before Christmas.
So basically a little over a year after you purchased it.
That's right, about a year.
Okay.
A year is when we were able to officially start again. And we had to explain that, hey, listen, we haven't reconfigured any units. This was the way the building was. There was mold. We took down drywall. We were going to put the drywall back up. And naturally, they don't really care. Their thing is, hey, you have to follow the letter of the law. Here's what you have to do to make it right. And, the blessing in all this and the silver line is that I ended up becoming, I don't want to say friends, but well acquainted and with an open line of communication with the head building inspector, the inspector for that area, and really understanding the building process down at the city on the commercial level. Since we had done a bunch of residential stuff and never had an issue, I mean, this was the first time of really seeing who the commercial building inspectors were, how they operate, what they want to see, how to communicate with them, how to get on their good side to where you don't ever get in this situation again. And so, thankfully, so we ended up getting the building permit in December, and, basically what that meant was the city inspector had to walk it with us, right, and tell us exactly what he wanted to see, and then he would say, okay, I want you to put insulation in these walls and call me when you're done. So then he'd come through and pass the insulation. And then he'd say, okay, I want to see the drywall, the sheetrock done in these units. And then he'd come by and pass that. So basically every phase of the construction he wanted to pass off on. Same thing with plumbing, same thing with electrical.
And once you had that done, was he pretty quick to get back out there, or what was the?
We could call him and he'd come out the same day or next day.
Oh, okay.
It wasn't bad then. It was just very monotonous. Every single, per floor, right? So he'd want to see 4 or 5 units at a time, want to check the screws, want to check the insulation. So it was just one of those things where I'm used to construction going very fast, as you know. A lot of the stuff we do is speed. And we kind of had an assembly line laid out, but this is the opposite of that. I mean, you're crawling, stopping, crawling, stopping. There's nothing to do with speed in this process.
And the building's completely vacant, right?
The building's completely vacant, okay. So we're just racking up $15,000 a month, $15,000 a month, And so that was, so learning that whole process was obviously a great learning experience, very painful, very, very painful. And
So you had mentioned earlier that you were textbook ready, so to speak. I think what you said. Like where did you even learn the basics of there? And the reality is, like, how much of that, the textbook stuff, how much was actually helpful to you once you started the project?
yeah, I mean, the book knowledge kind of goes out the window when you're in the middle of a fight like that. You're just trying to, it's just really survival. We're just trying to survive. But we had some good people around us. So we hired a permit expediter that basically helps walk you through the process of getting the permit expedited. So they've been through this thousands of times. They know all the people down at the city. They know who to call and what days to show up and how they want the plans presented. So that helped us a lot. I also hired a GC that had been through this before, so he was able to walk through this. And then we hired basically a superintendent to be on the job site every day to make sure that he would walk through with the city inspector and make sure that the trades were doing exactly what the city inspector would want. So I ended up learning, how to do some of these more intensive real estate projects. And, I mean, what you learn in a book is good, but there's nothing like just getting your hands dirty and learning it in real life. And sometimes real life can be really expensive, as this was. But that's kind of the price you pay to learn and do things the right way. That was several college tuitions right there, yeah.
Oh.
Painful.
And I know at some point, so I think at this point you're into when did you actually start construction?
So we started it in December of 2019. We got the permit.
Once you're done the stop work order and all that stuff, when did you actually start up again after you're done with all the plans? Actually started
we were full force in there again with all the trades. Probably January of this year.
Okay.
Yeah.
So okay. And I know at some point you kind of alluded to earlier that I think, put it politely, you did not meet eye to eye with your original investor. How did that play out, and how did you exit out of that?
Yeah, again, really painful. I mean, one of my big things with partnerships is that you really see what people are like when things go bad. When everyone's making money and things are going good, and it's 2014 and Denver's appreciating 8% year over year, and rents are appreciating, and everyone's raking in the cheddar. Things are good. It's hard to have disagreements, but when things go bad, you really see what people are like and what and how people are going to handle things. And obviously, there was a lot of mistakes that we made, things that we didn't realize, and things we didn't understand and couldn't obviously foresee. And it basically came down to the fact that we had just lost trust. We had lost trust by not verifying, by having issues with the city, by accumulating this massive negative carry, and by construction going way over budget and
so a lot
over
of it was
time.
just due to your
a lot of it was due to the issues we had with the. I mean, that was it. That was the issue, right? Is that it just had gone bad, and so we basically they were they're fiduciary. Other people are trusting them with money, so I take that serious. I understand what that's like, and so we just agreed to part ways. I basically wrote them a check. I forget the date, but basically for their principal plus 10% interest. And that was a 7-figure check. I think we wrote them a check for maybe close to $1.1 million.
Say that again. So you said 10%. That was that 10% kind of like that was their profit. Say, hey, headache. Here we go.
Yeah, I just I wanted to put myself in their position, and look, it wasn't their fault. And obviously I could have drawn a different line and said, hey, this went bad for both of us, and you're not going to if I'm not making money, you're not making money. But we still had a bunch of equity in the project, and there was still a slim chance that we could get out and make money, in which we've been able to come out ahead, and we can talk about that. But I just felt like it was the right thing to do, really. I just felt like, hey, a lot of this is on me. Obviously, we were partnerships and we had an agreement, but I'm not going to – I want to see them go on, have a profit on their return. Because at the end of the day, they did believe in me at the beginning of the project a year earlier. So, we wrote them a check on the principal plus their interest, plus 10% interest. And I actually felt good about it. I said, I wanted them to walk away of having made money, and, basically not being able to say really anything bad about the experience. They made money, even though a bunch of bad things happened, they walked away making double-digit return on their money. And I just wanted to be able to sleep at night knowing that I did right by them. And that's kind of what we did.
Well, I remember, I remember somewhere we were meeting somewhere in Cherry Creek that day, I think for coffee or just to catch up. And I think you were about to meet them or just met them, and you were like so relieved. Yeah, I remember that. Just you were like weight was off your shoulder. Using how physically it's like, oh cool, you can stand up like 2 inches taller. I remember that. Yeah, I remember that about you that day.
Yeah, that was it was a really grueling process. I mean, we probably went back and forth with attorneys for maybe 6 weeks, and these are like big boy, these are professional investors, right? So these guys, there's no messing around, and it was really stressful for me. It was really hard. It was the first time I'd been in a situation like that and had anything go wrong to that magnitude. And yeah, it was a really big relief just knowing that, okay, if I mess up now, it's my money, it's on me, and I just felt so much less pressure knowing that I didn't have to, there was no one that I was going to be responsible to other than myself. And yeah, so that ended up working out well. We were able to get through construction. We actually were able to pass our final inspections a couple weeks ago and started leasing 2 weekends ago. And the building turned out really amazing. I mean, it was probably one of the best finished product that I've done. We did everything really right for that neighborhood. And I kind of just got to the point where, hey, if I'm going to do this and it's just me, let's do it right. And so we spent a little bit more money than we thought. We did a mural on the front. We ended up doing some steel, kind of accents on the brick, on the exterior brick. We did an accent wall interior. We did some higher end backsplash. We did some butcher block mixed with granite in the kitchens. And anyone that listens to this can go and see kind of the finished product on the ride along and see the pictures. But really proud of how the guys, the GC that we hired and the superintendent and the team that we put together really executed. The architect ended up doing an incredible job. Everything it was a team effort. We got through it, and we had one of the silver linings is that rent actually increased from the time that we underwrote the rents to now $200 per month per unit. So that
They increased that much over
$200, yeah. We were pro forma I think at $11.95, and we're leasing units right now at $14.95 for the one, and $13.50 for the studio, I believe. I think Ben will give us the exact numbers, but yeah, so much higher than what we had anticipated a couple years previous. And the other good thing is that debt, going through this pandemic, debt, our construction loan was at 5.35, and the debt quote that we have now to refinance is at 3.75.
But that's for your takeout.
That's the refinance, right? Yeah. So debt's decreased, rents have increased, and I think we're going to be in a really good spot.
But what was your trick? Because I mean, like what I always see when I always tell my clients is like, as long as you can hold on the property in the long run, like you're really, really, really high chance you're gonna be wealthier than you would.
Yeah.
But you went through some big speed bumps, to put it politely. Like, how did you survive those big speed bumps? Did you guys pivot to like other financing, or was that just, hey, I know you're conservative, you have cash on hand. Was that just your cash on hand for the rainy day funds? Like, how did you survive that 1 year gap plus having to buy out your original investor?
Yeah,
keep in mind is that on the construction loan, the debt payment is coming out as you spend money on the line. So we weren't paying the 5.35% for the whole thing just on the acquisition because for that time we were stalled out.
Okay.
We actually just got to the end of the construction loan in July of this year. So now we're up to the full $2.6 million at 5.25%, and we'll refinance in the next 6 to 8 weeks.
And how much you're at 2.65 now? How much was the original acquisition for that?
It was 2.24.
Okay.
And then you can do the math up to 2.6 would be the construction line of credit when you're just paying interest only on what you use, and that interest only payment is coming off of the line also. So you're actually not taking away from cash flow, although we didn't have any cash flow, but in another circumstance, it's not money out of your reserve account. It's just coming off the line.
Okay.
Does that make sense?
When you say coming off the line, though, I don't...
So
it's
let's
prepaid
say you have
at closing.
$2 million left for construction, and the end of the month comes and you owe an $8,000 interest-only payment. They're just going to take that from the $2 million that you have left.
Oh, so you're actually not writing them a check. It's just coming down to your line, your construction.
You pay it at some point, right? Because once you fill that up, like we did,
exactly.
So since July, right, we've been paying $15,000 a month.
Now.
So it just ended up filling it sooner. So even though you're not finished with construction, you have to now come out of pocket.
I understand.
So you're paying it. You're just not. Yeah. You end up having to pay the piper down the road.
But at some point too, you guys have to probably fund more of the later construction.
That's right.
Out of your own pocket.
Oh yeah, for sure.
Since you'd already.
Absolutely.
Okay.
Right. A project that long, the chance that you're going to want to renovate the exact amount of dollars that you applied for on day one when you looked at the property is very unlikely.
Yeah.
So you're either going to come up less or above. And then one thing for the listeners is that's a tactic that you can use on a non-cash flowing asset, but obviously if you had the money to make those payments, you're not borrowing it at 5.35%. So I'm not encouraging people to pay debt with debt, but if you don't have the cash flow, like in this circumstance, that's possible.
Okay. So can we run through the financial
Yeah,
model
let's run
now?
through it. Yeah, Ben's got it.
Because I know we'll probably just run through. So talk about the pivot now, because I think you guys originally, your plan was to renovate this and sell it, right?
Yeah, originally that was the case. As we got through and we just started to look at the area, we started to realize the value of that land there with the duplex. We put a parking lot behind there. We reconfigured the lot, so now the apartment actually owns the parking lot. And we started to see the rents. We saw the finishes. And we basically rebuilt every square inch of this thing with, fully permitted. We started to look at rents, and then we looked at what the debt was. I think a big thing was debt going down, the rents increased, and then we sat there looking at it and like, what's a better use of our capital than just and once you refi, we're not going to be in hardly any of our original equity, and we're going to have a really, and Ben will go through the exact what we're cash flowing, but it ended up, it just was like a no-brainer, like we should just hold this. Now we are going to put it out to market and see if we can get a ridiculous high number from someone that just wants to own in the Highlands because it's sexy, but most likely we're going to end up holding it, and that wasn't the original case, but I think the collision of debt going down and rents going up just made it a perfect storm for it to make sense to hold. But that wasn't the original plan, like you said.
Okay.
Yeah.
So now so we're going to go through the model, kind of like
let's go through the model.
The current plan is.
Yeah.
Sure. So, like we talked about, we're looking at for the one beds, which are the majority, 18 of the 23 units, at $1,595, and then there's studios with and without Murphy beds, and those are going to worth about $1,350. And then Terrence discussed the duplex, which has been quitclaim deed, which basically just means that one entity gives another entity a property for $0. So the property that owns the apartment building now owns the parking lot, the duplex, and the apartment building. And so all in annually, we're looking at $470,000 gross.
And that's for rents, rubs, and parking?
Correct.
Okay.
All in. And so we're looking at a conservative appraisal at $6 million for everything. I think it would appraise closer to $6.5 million, but that's going to give us about with a 75% loan to value, somewhere close to 4.5 on the refi for a new loan.
Okay.
Which would cash us out for both our original construction loan, which we've been discussing in the last 30 minutes, plus some overhead that our company, the VareCo's, accumulated, both in adding on extra hard cost, and then we do an analysis of all of our projects and our overhead and calculate roughly what is the burden of the property to the team.
Just your general overhead?
Correct.
Okay.
Comparatively to our,
to manage the
everyone
asset
on the team, all their compensation, all the office, everything. How much does this property have an effect on that, and what's that worth? And then I add that to what we're in it for. And so at that point, we're looking at a net cash flow after debt of around $142,000 annual. That's with $83,000 in expenses and a principal and interest sum of $230, leaves you with $142 after debt NOI. And so from that point, we would be whole on the VareCo's contribution. And then I'll take, what is this going to cost to manage going forward? And that's a big conversation that Terrence and I have almost every other day on the impact on the team to manage a property by selling it, taking the cash, reinvesting it in another deal, and repeating the process.
And when you say management, you're not talking about like the property management. You're talking about the overall asset management, right?
Correct. Asset management property management, maintenance, leasing,
But if you guys
phone
hire a
calls.
property manager, how
Yeah,
much time is that taking away from your guys' actual
Because we're managing them,
HQ
right?
with
Because
the
we're
team?
meeting with the property manager every 2 weeks. We're going
Okay.
over what the tenant, and then we handle the maintenance because our guys have a warranty on the work, and we can just do it cheaper. So we still have to manage the maintenance.
Okay.
When there's fires with tenants, we're still being called. I mean, our property manager handles the leasing and collects the rent, but there's still a lot of work from Ben's standpoint every month, checking to make sure that the correct amount of rent was deposited in the
Yeah.
right account. I mean, even if you have a property manager, you still have to manage them and verify everything's done correctly. And on this size of a project, with that many moving parts, there's still a good amount of effort and resources that we would allocate.
Right.
Okay, that makes sense.
It's a basic time value of money analysis for Terrence and I to, weigh the benefits of a hold versus selling, because obviously the Highlands is undeniable a place to own real estate in Denver. If someone from out of state said, just sell me something where I know, there's growth is imminent, the Highlands would be first on the list.
Yep.
So, with that in mind, everything that we would look at, the burden on the team, the cost. I think we'd still be into it at about a 45% cash on cash with that annual net cash flow. And so, like Terrence said, we're going to probably bring it to market at a pretty ambitious isn't the right word, but a number that we would feel good saying, okay, for that we can do a lot with those dollars in another project, or holding it. And then a tertiary option would be to refinance and then divest some of the equity to some interested parties that have expressed they're wanting that to happen previously, and then building fee revenue for our management. So basically, when I was talking about what it cost, both hard and our management time, we would supplement that with, or we would cancel that out with fees from the members that we divest the project to. So we would reduce our position from the 100% owner to 50, 25, even 10.
And would that be separate from the refinance you guys were doing?
Totally refinance.
But would you have to refinance again?
No.
Okay, you just refinance and you could still...
We could take some of the
divest.
extra equity we have if people wanted to be part of that cash on, part of that yield. Because
Okay.
basically what, I think the good thing about this project was that we bought it right. Had we overpaid and paid 4.7 and then you go over budget and you have those holding costs, now you're talking about maybe not even breaking even. But because we were pretty disciplined on our underwriting to purchase it, even with all the mistakes, then we have the lucky break of the debt going down, rents going up. Now we're in a position where we're able to cash out all of our money plus a little bit more, which is what gives us that really good cash on cash return. Is the initial equity we put in, which I think is roughly 1.3, 1.4, we're getting all of that back plus all the overages. And then every year we have some expenses to manage it, but after we pay the debt, we're still netting $80,000 to $90,000, and we don't really have any of our initial equity in. So to me, that's the power of real estate, and if you're really disciplined of buying the property right. And so what we could do is get a hybrid of both worlds of hold the property, maintain control, but also take some of our chips off the table and let some other people participate in the yield, the ongoing yield. But we're not sure, how that's going to play out.
Are you still debating that?
We're still debating. One of the big things is that we had some big wins this year of properties that we had owned previously and sold. And to offset those taxes, we could do a cost segregation, basically just do an accelerated depreciation on all the construction that we did that then would help lower our tax burden for this year. And so that's another power of real estate, is that, even though the property is going to net us a good sum of money, because of depreciation, will actually show a negative carry forward from this project because of all the construction we did. And so it'll help us offset some of the other wins we had, which is really powerful.
And so, Ben, you had mentioned about a 45% cash on cash return. Is that with just all you assuming the overhead for your company as well? Is that assuming all that?
That's exactly right.
What would it be? Because if you got most of your money out, I imagine your cash on cash would be higher if you're just looking at the property itself, not assuming the your company's overhead, right? Wouldn't that be?
Yeah, I mean it would be 100 because you would have had your principal totally returned, and so
Yeah.
even if you made $1 on annually, you would have made 100%.
So you're getting close to where it's like on the math, you can almost get infinite return
Yeah.
type.
Well, actually, even more because are we getting money back more than our equity on the refi? Yeah, so we're actually getting more money back on the refi at 3.7% based on the appraised value because we're taking the duplex, the parking lot, and this as one property.
Okay.
And then we're able to refinance everything out and return, so it's hard to calculate that kind of return.
Yield, I mean, is income compared to what I have invested. So once you have nothing invested, that metric isn't super relevant. But
but it's cool to talk
it's
about
awesome,
on a spreadsheet to show the infinite return.
As we grow the team and bring more people on and grow, it's important. It's really important for us to understand, what would be called like cost of goods sold in accounting, which is even if you don't have anything invested, it does cost money to just keep the ship afloat and run every day. So to say like, oh, we don't have anything we got our money back, you got to be careful there. Same if you just buy single family homes and you're out of it, it takes your time and it takes bandwidth.
Yeah.
So we try to look at, what is the true cost to hold the property and at what rate is the net cash flow growing annually. That's a big part of it too, because if it's stagnant growth and our team's growing and our overhead's growing and we're not able to focus on our goals and where we're going and it's just sitting stagnant, that's a factor as well, which this property I think is probably of our whole portfolio, we can say by and large this one will generate more cash annually as time goes on.
Okay.
So if you look, I've got it running out to 2025, only at 2% rent growth a year and 2% expense growth, you're looking at a value of $8 million at 5.25 cap.
Wow.
So, and that's the duplex, the parking lot, and then
Yeah.
the parking. So yeah, it's yeah.
This is one of the reasons why I love value add, real value add, which is also with some more risk, right? We had some risk. Obviously, this one with the city, construction budgets go over. There's can be some bad. You can get punched in the face pretty good doing heavy construction. But this is why I love that is if you're really disciplined on where you buy it, you're creating equity that will then can last a really long time. As we created so much equity by doing the construction ourselves. Because to build 23 units in the Highlands right now, you're probably talking you're into that thing for $6 million or more, And here
Plus
we are.
Probably still longer than when you guys
right.
did.
Oh yeah, probably yeah. Once you get into entitlements, you're probably 2 or 3 years. So here we are, 2 years, and we're into this thing right now for maybe 4.25. So we've created massive amounts of equity by doing that hard work ourselves, which is why we love that model of buying outdated, underutilized buildings around Denver in a market that we feel really confident about long term. And creating that equity ourselves, and then being able to ride the cash flow for as long as we need to with our investors.
So, what type of financing are you do on the refi? Is it agency debt? Is it a local bank?
Well, we inquired about both, and so from the pandemic, we've talked about on the show before some of the reserve requirements.
Oh yeah.
Every time I check in with the couple agency brokers we have, I get the feeling that we're closer to those being released. But for this project, they're still in place.
Is that like a 12-month reserve?
Yeah, 12-month reserve, principal and interest, and then you can either apply it to the principal balance or you can just have it back. Or you can make payments out of the reserve account, basically allowing you to, it's basically just prepaying a year's worth of.
But you probably don't want
interest.
to stick away. I mean, that's going to be
Several $100,000.
a couple $100,000, right? Just sit in the account for who knows how long.
It'll do more invested in our deals.
Right. For this project, I'm really focused on loan to value, just because we have, we had 60% was the construction loan, 60% of total cost, and so, we want to create a margin of, if we are going to hold, we want to get the most cash out now to either, to reimburse ourselves, to reinvest in other projects. So the more basis points I can find between the 60% and say 75, 80, 85, the better for us. And so right now we're looking at 3.25% interest rate, 5-year fixed, 30-year AM at 75% loan to value.
Wow.
And so the biggest hurdles on, from where I sit are convincing lenders to take an appraisal with leasing just having started, only being 50%. I think signed we have a dozen filled. And so to go to the bank and say, look, these are the rents. This is what you should loan. This is what you should loan off of. There's some kickback there. Obviously, it's like, well, anyone can sign leases. You can just fill them out if you want. We want to see. We want to see. Okay, how
many months do they want to see seasoned?
Well, luckily, because of some of the relationships we have and the familiarity with this project in particular, specifically the bank that did the construction loan, they know there's no funny business going on.
Yeah.
But the solution that I'm constantly suggesting is just go appraise. Just go, we'll pay for an appraisal. Just go see it yourself. Do a rent study. Do a sales analysis, and you'll understand the value. And the more that train of thought is, we can agree on that vice. Okay, once you've had 6 months of stability, let's talk, the better for us.
Okay.
Obviously, we don't want to just continue making debt payments for 6 months while we let these leases season. So loan to value, and then an appraisal getting it appraised, and the document, the terms drawn up based on the appraised value is.
So is this bank, are they good with kind of what you proposed there, where come we'll do an appraisal now, pay for it, and they're good with that?
Yep.
Okay.
Yep.
One of the good things is that local banks. No, we haven't even ordered it. We can't order it until we have, I think, closer to 20 leases signed.
Okay.
Because we want it to be full and show them a 100% rent roll when they appraise it. I think one of the fortunate things about this property and why they're willing to do that is just be based on the location. If this was in a lower income area with higher crime, they would definitely want to see 6, maybe even 12 months of seasoning on the leases. But because of the location is A1 for a rental, that's why they're being a little bit more flexible, because a lot of banks want to hold debt in that zip code, especially with something that's been newly renovated and you've taken a lot of the risk out and all the capex has been performed. So that's one of the other things is just being disciplined on your underwriting and also location. Whenever you're in a tough season of being a landlord, which I think we're entering for sure, and people are going to be much more price sensitive, is really being focused on location. And because this is, we're fortunate enough that even though 2 years ago we weren't in a choppy economic situation, was that this location is A1, and it's going to end up getting us through and not having to wait 6 months to have it seasoned.
Right. 1.2.5 or 1.3 debt service coverage ratio is where a bank starts to feel really good about lending, and that you're going to easily make the debt payment. And this property, with pretty conservative expenses, is at a 1.6. So the bank
it's at 1.6 even at 75% LTV.
1.57 with and we've got property taxes and everything.
Wow.
Pretty generous for everything. So that's telling the bank, like, the rents in this area are such that these operators are going to cover their cost, and they're going to cover our debt payment fairly reasonable. Even if, and then we'll do since they'll draw down or draw up vacancy and the rents to find that threshold where they hit the 1.2. So they'll just keep working into the vacancy, 10%, 15, 20 until it comes out at a 1.2. And to get from 1.6 to 1.2 would probably be about 6 60% occupied.
Okay.
So that is really reassuring for the bank.
And so, are you guys? Is this a non-recourse loan? Do you know?
No.
No.
That's
Unfortunately, no.
a
Yeah.
factor that we can.
Like, how do you weigh that into your spreadsheet model and your risk mitigation? Because obviously, non-recourse is always ideal because we're not having to personal guarantee it.
Right.
How do you? Is there a way to quantify that risk?
Well, you just look at your balance sheet and say.
No, I'm saying
hey,
for you guys
you know,
internally.
Well, yeah, it's been hard because of the velocity of our capital and the amount of opportunity that we have, and just the return profile. Every 10% of equity, in this deal is probably worth $600,000 or something like that.
Okay.
It's worth, I think, $450,000, 10% of on the refinance. So naturally, if we invest the capital, even conservatively, at let's say 15%, that ends up being a pretty massive opportunity cost of that money working. And then, so we look at that. How much cash are we talking? If we're talking $100,000, it's not going to move the needle. But if you're talking $400,000, $500,000, $600,000 for every 10%, because to be non-recourse, you really have to be at 55 or 60. We're getting 75%. If you're talking 15%, you're probably talking $600,000 or $700,000 of equity, which, if you extrapolate that out, invested, then those end up being large numbers. So that's one of the things that I look at. Ben can talk about what he looks at, and then the second thing is just, am I fine with guaranteeing this property? And the answer on this location and with the amount of work that we put into it is yes. There's other parts of Denver that we've gone non-recourse just because it's much lower income and a lot more higher crime, and it's much more speculative. In this area, you don't really have to speculate, and the opportunity cost for us and our company leaving that much equity in that project ends up being pretty massive.
Yeah.
So
okay.
That's kind of how I look at it. But I'm also young. I feel like I'm in like my prime. So if things were to go south, I think I can make it back. Obviously, if I was in a different season of life, and I'm not in my mid-30s, I'm in my mid-60s, I'm looking to de-risk everything, and have as low leverage as possible. But I just don't think that that's in the season of life that I'm in, and I think specifically for this project, it's not totally necessary.
Makes sense.
Yeah.
Now, if you're in a real estate investor, you're thinking about personal guarantees, transaction volume annually is a big part of it. Our company does maybe 25 to 30 transactions, 2.5, 3 a month. And so, we're constantly liquidating properties and then buying new ones. And so, if God forbid something were to happen to this property and we needed the personal guarantee was going to come into effect, there's constantly liquidations. Whereas if you're at a point in life where you're looking at guaranteeing a loan and the only asset you have to guarantee it is a 401k that you can't tap into till you're 59 and a half, that's probably not a great option for you, because you're going to get hit with penalties to take
out
whatever.
the money. Yeah.
But if you're buying and selling real estate all the time, that's your profession. It's not going to be as challenging for us to cover debt because we're selling, buying, selling every year. Whereas if you want to buy a house in Breckenridge and you're going to personally guarantee the loan, you should think, okay, well, how will I actually do that? Where will I find this money? Am I going to have to call my buddy and ask him for
Uncle Sue.
Uncle Sue.
Uncle Sue.
And so that was a long way to say, I think, as a real estate operators who are, trading as the year goes on, there's a little bit less, it's feasible, for us to provide that liquidity.
I never thought that's interesting. Your perspective there, Ben. Just talking about how you guys, you're liquidating, a handful of properties a year that you always, should always have cash coming in. So that's, I guess, always like a kind of like a plan B reserve if you need it, right?
Right.
Yeah.
We generally tell the bank that we will not be guaranteeing it.
Yeah.
And then they send us 2 term sheets, and one of them has a guarantee. And then Terrence and I will look at it, and obviously it's his decision personally, but we'll look at, okay, what happens if we do it? Because at that point there's almost a cost to do it.
Yeah.
You're going to save some in interest. You're going to save, you're going to get a bigger cash out or whatever the case may be. So it's there's always 2. There's always, okay, this is the term sheet, but if you'll do the personal guarantee, here's the really good term sheet. And
Yeah.
so there's another analysis based on that.
One thing I like about multifamily is normally that first refi, you're trying to get a lot of your equity out. But on the second refi, normally 3 to 5 years later, depending on the area, that's when you're saying, hey, I'll take the 60% of appraised value to go non-recourse.
Okay.
That's typically what I've seen. Is, once you've held a property for 6, 7, 8 years on that second refi, that's when I think it makes more sense to go non-recourse because you've already taken out all of your initial equity. And now to be a little bit more strategic and say, I want a lower LTV to be non-recourse and de-risk, I think that makes a little bit more sense because there's no need to actually take more capital out because you've already taken out your initial equity.
And do you think this would be like a long-term hold where we may refi again? And
Oh, yeah, absolutely, yeah.
Okay.
Yeah, if we end up holding it and not selling, I think it'll be a 10-year hold kind of play.
Can I ask, what is the high number you guys would take to sell it, or have you determined that yet, or is that something you're keeping close to the chest?
Maybe something
Thinking about
north of
buying it?
like...
I mean,
He's
I don't
got-
have that
he's
amount
got-
of
he's
cash.
got
I'm
the
just
guys, yeah.
curious, so I got to learn.
We'd probably do it north of 6.5 with a pretty quick close and no hassle
Yeah.
process. Something like that would probably
Okay.
make sense.
I may
Ish.
know one or two people that may, so
Yeah.
I may
Yeah.
float by them, but that's, yeah.
I think in that range. It obviously is not going to make a ton of sense on a cap rate. It's probably going to be a pretty aggressive cap rate, but I think if someone's looking to park cash, can
Hey,
take
go talk to
50%
some
or less debt.
Californians, and they
Yeah,
may
you're
like
right.
it.
Yeah, for someone from California, New York, it'll make sense. But even that, it'll be pretty aggressive. But I think if you're a
Yeah.
long-term holder, owning that footprint in that location long-term is going to be better than putting the money in a savings account, a CD, or buying bonds.
Yeah.
And I think you can count on, a monthly check for sure. But it's got to be someone that has that kind of horizon.
So I'm looking over the agenda we put together. I think we hit all the bullet points here, except for the conclusion stuff. We talked all due diligence, financial model. Any deal specific stuff you guys want to talk about before we wrap this up?
No, this was purchased previous to what we did on the last two shows.
Yeah.
The syndications. So it if we did divest some of the equity toward two other people, there, the fees, and it would start to look more like a syndication in that sense. But where we sit today, this is no different than a value add home, single family home, or a duplex, or was purchased, rehabbed, and refinanced, and will either be sold or not sold. So it's not as far as the deal, it's really straightforward
Okay.
with a
Right.
chance to become more complex.
Yeah, I think the keys are just being disciplined on the underwriting when you buy things, because your things most likely are going to go wrong, and you have to be disciplined to make sure you have margin to make those mistakes. And obviously, we had a lot of margin on this. We made a lot of mistakes, and we had some lucky breaks with like we talked about debt and then rents going in our favor. But sometimes they don't go in your favor, and you need to have enough margin baked in and assume, plan for the worst and leave yourself some room for things to not go well, like on construction, like with the city,
We'll talk about that soon. So let's say debt stayed about the same about 2 years ago, and rents did not go up so drastically.
Mm-hmm.
Rents, say they went up a couple bucks, just general
Right.
inflation stuff. Would you guys probably be selling then, and would that be about a break even? What would you already even know?
Well, we're into the property for about what, 4 million, 4.1, 4.2, under 4.2, and even in the most conservative underwriting to trade at 5 million, that building. So we'd still be good, and then we added value with the parking lot, so that would add some equity, and then the duplex has done well. So I think we'd probably be more seriously looking at selling for sure. If interest rates were higher and we're going to get that kind of yield by holding
Yeah.
it, we'd definitely be looking at selling it because there would be people looking to buy it in that location. So I think, yeah, absolutely, that would probably be more of a consideration, and option A.
Okay. Well, great, guys. This has been helpful. As usual, I learned a few things, so I appreciate it. I think the listeners did as well. And people can go to the website. It's the VareCo.com, right?
That's right. Yeah.
And the link will be in the show notes, so you guys click there. But TheVareco.com.
That's right.
Short for Value Add Real Estate Company. go there to learn more about it and get in touch with you and Ben if you guys want to talk details on projects you're doing, investing in the future, or also bring you guys a deal as well, right?
That's right. Yeah, anybody that likes to look at real estate deals, that's a broker. We're always looking for value at deals just like this, just underutilized apartment buildings in core Denver. And then anyone that's looking to invest in apartment buildings and wants more passive cash flow, understands the risk associated with investing in real estate and is comfortable with that. That's obviously what we do. We do it in Denver. Every deal basically is in Denver, Des Moines, one of our backyards, place that we already operate. And we have a bunch of really good projects in the pipeline, and we're looking to kind of expand our investor base and do projects just like this one.
Yeah, so I'll just, if you guys have interest, reach out, because Terrence, I remember when you and I met 3 or 4 years ago. You were doing all single family fix and flips back there for the most part, but you built your business off of networking.
That's right.
And podcasting, phone calls is still networking.
Absolutely.
So,
we're definitely looking to build relationships with people in Denver that believe in the market and want to be in larger deals that maybe they can't take down themselves, and be a part of a group that's doing them at scale.
Cool. All right, guys. Well, Terrence, Ben, I appreciate it. Thank you.
Yeah, thank you, Chris.
Thanks, Chris.